Washington's far-reaching tariffs will have an immediate impact on world economies. For some countries like Canada, tariffs have already been working their way through. For more on that impact, let's go to James Orlando, Director and Senior Economist at TD Economics. Thanks for joining us today.
Thank you.
So essentially, auto tariffs are the big takeaway from what was announced yesterday for Canada. And we're seeing some layoffs already today. In each country, there's either a pause, some sort of temporary layoff. Should we expect more of this soon in Canada, the U.S. and Mexico?
I don't think we've seen really the beginnings of layoffs in Canada just yet. When we did our forecast back in March, what we said was the Canadian economy was likely going to enter a technical recession. That means the unemployment rate is going to rise. That means we're going to have significant job layoffs. So we're starting to see maybe just a little bit of nuance of that today. But there certainly could be more to come as this political uncertainty continues.
As you know, Ottawa is now going to tax American vehicles coming into Canada. I'm wondering if this will hit American consumers more than Canadians, which is likely the aim. Can you still hear me, James?
Yeah, I can hear you now.
Okay,
sorry. Can you repeat the question?
Yeah, I just wanted to ask you, and I know you know that Mark Carney announced that Canada will reciprocate by putting some tariffs on American vehicles coming into Canada. Will this hit the U.S. fairly hard?
It should, yeah. So I think when we look at the impact of tariffs, what we're doing is, one, we're hitting economic growth because what's happening is the price of a lot of goods are going to increase for Americans. This also means that inflation is going to rise. Some estimates of auto tariffs are that it will cost an extra $5,000 per automobile as a result of these auto tariffs. Now, a lot of this has to be parsed because there are exemptions for USMCA compliant goods. Now, how quickly can firms go from non-compliance to compliance? That's a really big question. And that's really the only way a lot of these firms are going to be able to save consumers a lot of money. But to your question, yes, Americans will be paying more money for automobiles amongst a host of other products they're going to be facing.
Let me ask you a question, which is kind of wide. It plays on what you were talking about. How easy is it to become CUSMA compliant if you already aren't CUSMA compliant? And is there clarity on exactly how much is and isn't?
Well, I think we have some information about how much is and isn't right now. Some of the estimates are around 40% of goods that go from Canada to the United States are compliant. That leaves a huge amount that are not. Anecdotal information we get is that this seems to be paperwork that firms can fill out. The uncertainty related to this is that we actually have no idea how quickly firms are going to do it. That's why when we talk about the effective tariff that Canada is going to be having right now, it's a big range. And that range is dependent on how quickly Canadian firms are able to change their paperwork around to do this. But yeah, that's huge uncertainty for us because we have no idea how quickly firms are going to do this or if they already have done it. So I think this is big for us to determine just how much pain Canada will suffer as a result of all this.
What do you see ahead for inflation, both in the U.S. and Canada, as this begins to settle in, and how quickly?
So in Canada, we have inflation already on the rise in this country. We had inflation going to the below 2%, and even without tariffs, we were going to have inflation going towards 3% in the coming months. Now, there's a few push or pull factors going on right now. One, you had the ending of the GST, HST rebate that was going on in the winter months, but now we also have the impact of the carbon tax going to zero. So we've already seen that in gasoline prices. That's going to be a deflationary force for CPI. But once that's passed, we're looking at inflation going above 3% and maybe pushing towards 4%, depending on how this tariff fight plays out. So inflation much higher in Canada than we've been used to over the last few months. And I think this puts central banks like the Bank of Canada in a bind because we have the downside risks, the growth, but you have inflation going up. So how much do they, which of those two do they want to weigh? Do they want to weigh the downside and the risk of recession right now? Or they want to say, okay, inflation's high and we just experienced the COVID inflation. We don't want to get back there again. So I think the central banks are going to be sort of in a push-pull situation because inflation is definitely going up from here.
Okay, so what happens 6 months from now? I'm wondering whether you think the tariffs are going to last for that long, if you're planning for that, and what that looks like.
I think the baseline that we've been going with is that this should last for 6 months. It depends, obviously, on some negotiations that could come through. But when we did our forecast, we said, okay, this is likely. Tariffs are here to stay. They're here. Even if they come on a little bit, they come off, they're still going to be at a higher level than they were before. So we did a 6-month, 1 year, 2 year scenario for how tariffs are going to play out. And from everything that we've been seeing, this seems like a situation where we think President Trump needs tariffs on. One, he could use the funding to actually fund some corporate tax cuts. That's an option for him. But also, there's clearly a belief that tariffs are a means to get more production back in the United States, so more onshore in the United States. And that's not something you would see very quickly. Now, so from our perspective, we're assuming these are on for at least 6 months, which actually brings Canada into what we call a technical recession. So 2 straight quarters of negative economic growth. And so I think that's just the baseline that we're working with. And obviously, this could extend even further, which would be even more severe for the Canadian economy.
All right, James Orlando, I've got to leave the conversation there. Thanks for joining us. James is a director and senior economist at TD Economics. Thanks for that. Coming up.